Have you heard that the 60/40 portfolio is dead? You know, that pie chart looking thingy where we put in 60% stock funds, 40% bond funds, park it in our 401k, and we just coast on into retirement? How's that working out for you? Don't worry. I'm going to show you a new kind of 60/40 portfolio using blockchain assets like LUNAx and aUST. And by parking it into a thing called mirror protocol, we're going to use a very unique form of strategic leverage to simultaneously hedge our 401k against a stock market downturn. None of this is financial advice. It can't be. Why? Because I'm not a financial advisor. At least I'm not one anymore. And for those of you that don't know me, I'm Hutch, and you can follow me here for all things crypto related. So let's get into it. So the reasoning behind having a 60/40 portfolio is sound, and we're going to attempt to adhere to that in constructing our crypto 60/40 portfolio. It's just that the TradFi alternatives, usually the S&P 500 and some kind of aggregate bond fund, is a little rich and frothy in valuation or low in yield, and not so with LUNAx and aUST. But again, the reasoning behind wanting to have a 60/40 portfolio is to have a combination of growth and yield-bearing assets, and diversifying between growth, volatile growth assets, and yield-bearing assets can help you smooth out the overall standard deviation or volatility. And rebalancing to the 60/40 portfolio can automatically help you buy low and sell high. And as you think about all the other early technologies that you missed out investing on, like Apple, like Amazon, like Zoom, like so many others, think about all the negativity that you may find out there from the masses that really want to wait until things are safe. But just remember, if you wait that long, that will be priced in at that time. And if you do your own research now, you may come to the conclusion that you truly are early on something that is going to revolutionize money as we know it. Think of what industry hasn't been disrupted yet. Or maybe you just don't have time to do all the research and you just say, you know what, I'm going to pick an amount that I can take a leap of faith with and put it in there and see what happens. And we can find a similar disparity in yield between aUST, our bond proxy or decentralized stablecoin, compared to the traditional finance alternatives, like different bond funds. If we take a little bit more risk in the what's called the investment grade corporate bond fund, that's currently paying 2.48%. And if we look at risky bonds like junk bonds, ooh, you get paid for taking that risk, 4.47%. Yeah. And if we look back to when there was really serious volatility in 2008, all of these bond funds didn't lose as much as the S&P per se, but they lost 10, 15, 20, 25, 30, 40% during the same period, and that's not what you would expect for bonds. So although a decentralized stablecoin like aUST may seem risky to you, at least you're getting rewarded for taking that risk with a 19.47% yield. And I realize alarm bells are ringing, and again, you'll find lots of negative opinions about why this is not sustainable, and I agree, it's not, but it is happening now. And if you believe in the future of decentralized money and the fact that transactions will take place and saving and lending institution like Anchor Protocol, which promises this 19.47 yield, works like a bank but cuts out a lot of the middlemen, sure, some amount is sustainable. And you can be an early adopter and get this, some would call it a teaser rate. Others would say, you know, Apple, Amazon, all these companies lost money as they were growing and they grew into it. And you can do your own research to really decide if you want to get comfortable with this, or you can just take a leap of faith for some amount where you feel like you're getting rewarded for taking the risk, or you can just wait until the yield isn't as good. So if you like these DeFi ingredients of LUNAx and aUST, you can obviously start whatever kind of allocation you want and set it and forget it, be it a 60/40, a 80/20, a 30/70, or you can juice up your holdings by using some very strategic leverage via mirror protocol, which can also simultaneously hedge your TradFi portfolio like your 401k or your brokerage account against a major market downturn. So people in crypto always talk about being tied together at the hip with Bitcoin. Come on, Bitcoin. Bitcoin, go King Bitcoin. Well, if there's King Bitcoin, there's also Emperor S&P, and it affects all of us, at least a downturn would. So for my DIY folks, I'm going to show you how I do it, but just remember, this gets complicated, and Stater Labs will be offering a done-for-you solution with their Degen vaults, where they handle all of this setup plus the monitoring and manicuring, but you should still understand what's happening behind the hood, so let's get into it. So Mirror Protocol is almost like a synthetic DeFi brokerage account. And so you see a couple of stocks you recognize like Apple and Airbnb. And the reason why there's an M in front of it is because they're mirrored versions, and they won't track the price exactly, but they will correlate to its movement. And you can see other stocks you recognize as well as crypto like Bitcoin. And if we scroll down, we're going to get to mSPY, which tracks the spiders, the ETF that tracks the S&P 500. And we're going to use this mirrored asset in a very unique way to provide a very favorable form of leverage. All right, so we're first off going to go to the Mirror Borrow tab. And I realize the word borrow makes some of you very nervous, but bear with me because this loan is unlike anything you've ever seen. And in order to borrow from Mirror Protocol, we have to park some sort of collateral. And the most optimal collateral to park is collateral that's also working for you while you're borrowing it. And that's why we're either going to use LUNAx or aUST, because both of these tokens are auto-compounding within themselves. So Stater Labs is basically staking your Luna, and they're auto compounding all of the staking rewards back into the LUNAx token. aUST is earning that 19.47% or whatever it is, and they're auto compounding those earnings back into the aUST token. So over time, even if we're parking these tokens as collateral, they're still working for us because they're growing over time, even if their value stays totally flat. So what are we going to borrow? We're going to borrow shares of mSPY. And if we just hold those shares in our wallet, it essentially means we're long the S&P 500, but there'd be no point in doing that because our loan on Mirror isn't denominated in the dollar amount we borrowed, but in the number of shares we borrowed. So even if the value of the S&P goes up, we owe back the exact amount of shares. So what we're going to do instead is right as soon as we borrow, we're going to swap or sell the shares of the mSPY, and we're going to exchange that value for either LUNAx or aUST immediately. And then once we do, we're going to repost the newly bought assets on Mirror as collateral and repeat the whole process over. Borrow some more mSPY, swap or sell them, and then take that value and get either more LUNAx or aUST until you have an allocation you're comfortable with. Now, I realize that was confusing and you probably have a lot of questions. Don't worry, I got you. I've thought this whole thing out. So let's address the first elephant in the room, the fact that we're short the S&P. We borrowed the shares and we swapped or sold them immediately. And since we owe back the shares, if the S&P does rise in price, that will erode the overall profitability of this strategy. But let's put it in context. So even though this chart is up and to the right, and most people just perceive the fact that S&P is up only, when I ask people if they think as an economy we're out of the woods yet, most people would say no. And the fact that we've gone up so much is largely because of stimulus. In fact, if you look at this last parabolic move, it's the most stimulus we've ever done, and we've been doing it since 2008, 2009. The other thing I would say is, for the most part, other than those parabolic moves fueled by stimulus after a big downturn, the S&P tends to melt up, or as I say, it tends to take the stairs up and the window down, which actually provides an opportunity for us to tactically close out this loan on these dips. And lastly, when we compare the S&P to something like Luna, because at the end of the day, all that really matters is the relative performance between the S&P and Luna, when we overlay these two, even though Luna hasn't been around as long as the S&P for this chart, since it has been around, it is severely outperforming it. Yes, that little line down there is all those candles being compressed when Luna's overlaid on top of it. So I'm not as worried about the S&P going hard and aggressively against the price of Luna, but Luna is a much more volatile asset since it's so young in its nature, and so you have to be prepared to manage the downside volatility. So when you post LUNAx as collateral against the S&P and you have these big drawdowns as we've had, you have to be prepared to throw more collateral against it, whether it be coming from collateral staging that you have, or maybe you're just prepared to DCA into these dips anyway, in which case you'd have no problem just stacking more and more collateral. As far as the aUST part goes, as an instrument, it doesn't fall in price. In fact, quite the contrary, it just crawls up that 19.5% trajectory. So really, as long as it outperforms the S&P, you're technically ahead of the game. And when we think back to those early bond yields I shared with you for 2.4 for investment grade bond funds and 4.4 for junk bonds, even if the S&P goes hard against aUST in any given year, you're still ahead of the game compared to a normal bond fund. But I would contend that parking some aUST against the S&P 500 would be part of your collateral staging method. So as you have some of that aUST parked against the S&P 500, theoretically, when the price of Luna falls, you could choose to cash in some of those positions. You could buy some S&P shares to free up that aUST and use that to dollar cost average into more LUNAx. That's one possibility. But even if you just kept an aUST component, almost like a bond component, I'm going to show you on this graph what it would take for the trade to go against you. We can use this monthly chart to see what it would take for the S&P to go against an aUST position, much less a looped aUST position where we're actually multiplying that 19% yield using the leverage. So each of these candles is a month, and you can see these lines represent year to year. So if we measure from here to here and just annualize it, because that's the 19% number, the S&P would need to get all the way up to here in this time frame for you to be break even. Now, this isn't taking into account the fact that there is a 1.5% fixed mint fee, and that's just to close out the position. And that's the only stated cost of this loan. So there's no interest accruing against you, just the possible S&P movement. And there's also some skew, otherwise known as premium, inside the mirror protocol, which may go against you. But I'm going for a big downturn before I personally close out my position. So these things are a small conversation to me. So just following along this line, if I looped enough aUST to get 1.5x, well, now I can get north of 27% on the same dollar amount. So really the S&P needs to get to here for me to be in negative territory. And if I double the amount of UST I get by looping, I would need to get all the way up to here in this time frame for this to be a bad trade. Now, this may happen. I want you to understand that this is a genuine and bona fide risk. I'm not saying it can't happen. They could keep printing money and fuel this thing to oblivion. But at some point, what goes up must come down. And you can even see that in this chart. There's lots of little blips and some bigger than others, like in 2008 and 2020. But even along the way, there's smaller dips, and that's when I'm recommending that you strategically close out at least parts of this loan and take some profits. So I'm going to show you a couple of examples. And remember, you can go as aggressive and as conservative as you want with this strategy, but I'm going to show you a couple of middle of the road examples that I personally did. And let's start with one that tilts more towards Luna, although we are going to get some LUNAx and aUST with it. With both of these examples, I started with 100 LUNAx of collateral, but if you have more aUST, you can also start with that as well. It'll just be more conservative of a position. So with my 100 LUNAx as collateral, I borrowed 8.6 shares of mSPY. I actually swapped them directly for more LUNAx, and I was able to get almost 42.96 LUNAx out of that, for which I provided as collateral right away. Got 3.7 shares of mSPY, swapped that. I actually swapped that directly for UST rather than aUST because I found it was better just to swap for UST and then pay 25 cents to get aUST. And then I provided that aUST on Mirror Protocol to get 2.46 shares of mSPY, for which I swapped that to UST and then parked it in Anchor as aUST. So what happened with all that? Where did I end up? Well, we started with 100 LUNAx, worth about $8,500. Then we borrowed and sold shares of mSPY to acquire another 6,400 in assets. So we basically multiplied the amount of assets we started with by 1.75x. Now, that sounds risky, but put another way, the additional leverage we took on went 57% into LUNAx and 43% into aUST. So this extra leverage amount is basically like a 60-40 portfolio, which we want to be more conservative since it's tied to a loan. And I also want you to keep in mind that the final shares of mSPY, they were sold for $1,035 of UST that went into aUST, and that's totally liquid in our wallet since we didn't loop it to borrow more mSPY. So 12% of our initial stack value, 12% of 8,500 is completely liquid, earning that 19%. And it can be deployed to buy more LUNAx on any dip. So one of the clever things I can do with that aUST I got from my last loop, remember the 1,035, it's been a few days, so it's grown to 1,036 and change, and I didn't loop it back, and I'm not ready to buy Luna now, even though it's coming down in price. It's in right around $80, but just in case it goes down, I could buy the Luna for, I can buy some B Luna for a discount using Orca, Team Kujira's Orca protocol, and I can bid at a discount that will wipe out, I shouldn't say slippage, but just the exchange rate. And to show you what I mean, even if I do a slow burn or an unstaking, a 21-day slow burn unstaking of 1 LUNAx, I'm going to get almost 103 Luna, 1.029 Luna. So that's the true exchange rate for LUNAx to Luna. And it's even a little bit less because of the ARB with B Luna. So if I go to Terraformer and I put 103 B Luna, you can see I can get 100 Luna, but that's just because Terraformer routes it to 2 different places. But then if I did it on TerraSwap, I get a little bit less. I'd get 99.9, and if I did it on Astroport, I'd get 99.6. So if I bid on higher than a 3% premium, I'll actually come out ahead if I bid in the 4 or the 5% pools. And since I can bid in aUST, yes, I'm losing some of the 19.5%. I get 15%. But since, again, my cost of the loan for the loop that got me this 1,000 of aUST is 1.5%, I'm still well ahead of the game. Now, we'll discuss how to manage these ever-changing collateral values, but let's do another example that's a little bit more conservative first. So for this next example, there's a little bit more of a tilt towards aUST than as much LUNAx. And it's also worth noting that on this day, 100 LUNAx was worth 8,800 and change versus 8,500. So we got a few more shares of mSPY and we swapped that for aUST, about $3,700 worth. And because you're actually allowed, since aUST is a more conservative, less volatile asset, we're actually allowed to collateralize it a little harder than we can LUNAx. We'll talk about that in management, but we got more shares of mSPY, 5.3 shares, and we swapped that for almost 25 shares of LUNAx, 24.9 shares of LUNAx, and we swapped that for additional shares of mSPY, and which we sold for 930 UST, which we deposited in Anchor. So how does this one look? So this time we started with 8840 worth of LUNAx, and then we borrowed and sold shares of mSPY to acquire another 6866 of assets. So basically our multiplier is 1.78x here. Only this time of that leveraged amount, we only put 32% in LUNAx and 68% in aUST. So it's a lot more like a 30-70 portfolio here than a 60-40 on that leveraged amount. And being more conservative will actually help you defend a loan more in a downturn. But keep in mind, since that last loop against LUNAx was against LUNAx, we couldn't borrow quite as much because we don't have as much capacity to borrow against LUNAx. So the liquid amount sitting in our wallet is only $930 worth of aUST, and that's only about 10.5% of our initial 8840 investment. Now you can always close that middle slice, that second loop that's backed by aUST, but that comes with some additional costs and complications. And this is a great great time to get involved for me to share with you the managing tactics. But let's first start with our managing mindset. So you need to always be prepared to buy LUNAx on dips. You have limit orders right now on Meow Trader, and they're coming on Prism Protocol and TFM.com. And you should save capacity for another leg down because you never know where the bottom is going to be. So you want to have collateral staging somewhere, whether it's an aUST or you have other Luna derivatives and liquid LPs that you could swap for LUNAx and park as collateral against your loan. Whether you do, whether you don't, you should always be prepared to DCA some additional backup collateral. Again, if you think the long-term price action of Luna is going to go like this, then when it dips, you shouldn't have a problem taking normal cash flow and buying additional LUNAx that you could slap onto your position to protect from liquidation. Now, that's in a downturn. When LUNAx is going up, it's a different managing mindset. You want to start releasing bits of collateral during all-time highs. Now, obviously, you want to stay within your comfort zone, and there's no love lost for just keeping LUNAx as collateral since you're still earning your staking yields. But if you could juice up the LUNAx yield with something like Edge Protocol by supplying LUNAx as collateral, borrowing some Luna derivatives to farm and get an extra bite of the apple, that may be worth considering. And I have an entire video about that you can check out here or in the description. You can also loop additional aUST using Mirror if you think that SPY is still overvalued and has a chance to go down. Again, that's not quite as liquid. And whatever aUST you have in your wallet, you should always be prepared to buy some dips. All right, so now I'm going to talk to you about managing a position because we put our position on here at around 88, one of them at least. Luna fell, it came back up, it fell all the way down here. And over the weekend, we were way down here in the 77, 76 range, and I thought we were going to just plummet. So what I did is I had some LUNAx in Edge Protocol for collateral staging. I used the LUNAx itself is already earning staking yields, but I use Edge Protocol to juice that up even further. And I have an entire video about it here. You should definitely check that out. But what I did is I closed up those LP positions that I borrowed against my LUNAx while it was still earning staking yields to juice up my returns. I closed them out, closed out the borrow positions, took some of the LUNAx and posted them here as collateral. Then come to wake up Monday morning, Luna did what Luna does, and we're way up here at 93.77. So now I'm going to show you how to release collateral from the position and put it back into Luna Edge. What we'll see, if you remember, we started with 100 LUNAx at the bottom. Now we're up to 126. And again, I just did that to protect the position because if I click manage here, when the price of Luna is going down, I was getting very close to this red. It was actually in the low 200s here. And the minimum collateral ratio, or MCR, where I get liquidated, is now 173.33. This brings up another risk that I need to show you guys, and it's why my video is late here. If we go to the Govern tab, and scroll down here, you can see these governance proposals increase mSPY MCR from 110% to 130. Now that was the ratio for aUST. And I didn't realize they were also changing the ratio for LUNAx. So looking at my position, you can see that the aUST ratio is 130. I went ahead, I was already over collateralized enough, and I'll show you how I figured that out. I just take 130 and I just pick a number. I go, I don't think the S&P is going to rocket up 120% overnight, or 20% rather. So 1 plus the 20%, I'm still under my MCR. So I feel pretty comfortable with that because aUST isn't going to fall like the price of LUNAx can. So I'm cool with that. And if you remember, I had that $1,035 I had in Team Kujira. It did not execute. My bid didn't execute even though we fell. But I can always slap that against here, or I could buy LUNAx on dips. So now I'll show you how do we calculate what our liquidation price is, or our line in the sand. It's complicated because it doesn't give you the number. That's because we have two variables. We have S&P that could go against you upwards, or LUNAx that could fall. So we're going to use the old cross multiplication technique from Algebra 1. So if we look back at the price of Luna, we're at 94 right now. So 94 is over, or 94 is to 308%, as X is to 173.33, my new higher liquidation price. It used to be 146.66. So that is another risk. If you have to monitor governance proposals, because they could change that and you could get screwed overnight. So if X is over 173, we need to multiply 173.33 times 94. I'm just going to use around 94. And so then we have to divide, it's 308 times X. We have to divide X, or divide 308.79 by this. And you can see I have around a 52 and change liquidation price. Now I feel very safe with that. Why? 52 is way down here. I can always add collateral. So you can only remove collateral when the market's open, and I need to hurry because it's going to close in about 13 minutes. But you can always add collateral whenever you want. And I've been told, I've never been liquidated, I've been told you can only get liquidated if the market's open. So you have the whole weekend to add collateral positions. So let's just see, we're at 94. I'll show you how I kind of calculate where I want to be. 308's a little much, we know that. What if I went to 250? So I'll take 250 and I'll multiply it by 0.7, because we know that Luna can lose 30% of its value. So voila, that gets me to 175. People that are more conservative, notice 175 is over 173. There's not a lot of room for the S&P though, for that variability. So what if I say 260 times 0.67? So now we could lose a full third of its value. It's still right above it losing a third of its value at 260. Just to be safe, I'll probably go there. So if I click into the smaller position, the one with 31, you can see I had some collateral staging to spare. I don't need that for this, so I'm going to put this with edge, but I'm also going to take some out of here. So if I put it to 260, you can see I can get about, I don't know, about 5 LUNAx out. Now, I may just push the envelope on the smaller position first, because I'm less concerned about getting liquidated with the smaller one to the big one. So we'll just say, we'll go in between. We'll do 250, 253. So that gives me a lot of room here. And all I'm doing is I'm editing this. So if you wanted to add, you would just type the amount you would want to add, and it would show you where you're going to get to. I could also just type it in here, 255. Okay, it gives me a nice clean 5.4. I click edit, and we just went ahead and got rid of that. All right, so it shows me I withdrew 5.4 of collateral. So similar story. This one I'll take to 260. I don't want to get liquidated there. And you can see that I'm going to get out about almost 20 LUNAx here, which is nice. So let's discuss the final component of this whole strategy, how to close out your loan position. So how we would do it is we would actually click this close button up here. And when we do so, you can see it tells us the exact number of shares that we borrowed, and we need to replace them. So just like most people in crypto are trying to buy low, sell high, in this case, we hope we sold high and now it drops and we get to buy low and replace the same amount of shares for a smaller dollar amount, and then pocket the difference between the mSPY spread, plus hopefully LUNAx or aUST has appreciated against it. Now, it doesn't give me the option now because I don't have mSPY in my wallet, and also the market is closed. But I would click here and it would open up a widget for me to go ahead and buy the exact number of shares. I was told before that it's best just to copy this amount. I would round up. Having closed these out before, the worst thing that could happen is you pick the exact amount and then a little bit of slippage happens and you can't close out your position, and you're getting close to 1 o'clock or 4 o'clock, whenever closing time is in your area, and you're like, darn it. So buy a little bit more and just go ahead and sell the difference when you're done. One last little intricacy of this strategy, and that's the premium. So this is a little bit of skew with between the Oracle price and what it's actually trading at on Mirror. And I'll give you an example. If I pull up the trade tab, it actually shows both. So you can see the Oracle price for mSPY is at $443, yet the pool price, their skew, it's only trading for $420. Now that's great if we want to buy this back at a discount, but I sold all the shares I did short, and there was already some sort of negative premium somewhere between -3 and -6. And if later on when I go to close the position and more people are buying mSPY than selling them, that's what causes this premium. When more people are short than long, you can get negative premium skew. When more people are buying than selling, then you can get positive premium. So technically the trade could go in my favor, but if the skew gets really out of whack with this premium, that will cut into my profitability. Truth be told, to me, this is a small conversation. The mSPY part of the trade is not the main part. It's just a placeholder for me to loop LUNAx and aUST against, mainly LUNAx. And so I'm expecting that to greatly outperform the mSPY. Plus, I'm planning to close mSPY on some sort of major dip, some sort of double-digit dip, in which case this becomes a smaller conversation for me. Again, when you look at the overlay of the Luna chart to the mSPY, this really paled in comparison. But if it is important to you, know that this can cut into your profitability. But if you were expecting the kind of bullish move out of Luna that I am in the long term, then it shouldn't matter that much. And I realize that for a lot of you, this is a lot to manage, a lot to think about. There's more moving parts than other borrowing strategies, and this may be too much. For my DIY friends, you probably love this video, and I hope this helps you. But for the others, just remember that Stater Labs is coming out with a Degen vault, and my hope is that we will have different risk models, like the moderate, the growth, and depending on what your own risk tolerance is, you'll just be able to deposit LUNAx, and they'll be able to handle all this for you in the background with automation. That's what DeFi and Web3 are all about. So I hope you enjoyed this, and we will talk to you next time.